Hi, welcome. Now, in the previous class, we started discussing the cash flow of a mortgage pass-through, and we looked at an illustration from the curriculum. Now, we said the cash flow to a mortgage pass-through, just like any other bond, is made up of a principal payment and an interest element. Now, the principal is made up of a scheduled principal repayment and prepayment. So the total cash flow is a scheduled principal repayment, prepayment, and then the interest, that is the pass-through rate. These three form the total cash flows or total cash flow to the mortgage pass-through investor. This time we want to look at what we call the weighted average life. Now, although a mortgage pass-through security has a legal life, let's say for example you issue a 5-year mortgage pass-through, 5 years is the legal life. Now, the legal life does not it doesn't throw light. It doesn't inform us a lot about the interest rate risk around the mortgage pass-through. Hence, we look at a pass-through. We look at, the weighted average life, or the average life for short. Now, what is the weighted average life? Now, the weighted average life, or the average life for short, is how long it takes to receive all the cash flows on our mortgage pass-through security. Now, in our example, we projected a 165 PSA, which implies that we'll get back all our cash flows in 8.6 years if the prepayment speed remains at 165 PSA. If prepayment speed becomes faster than 165, we're going to get our cash flow shorter than 8.6 years. If it is slower than 165 PSA, we're going to get our cash flow longer than 8.6 years. So we call that period of time within which we get back all our cash flows as the average life of the mortgage pass-through. So the faster the prepayment speed, the shorter the average life of the mortgage pass-through. But the slower the prepayment speed, the longer the average life of the mortgage pass-through. Now, our example we discussed last time, let's look at the average life. Look at it here in this schedule here. Now, our prepayment assumption was 165 PSA, and we expect to get back our cash flows in 8.6. This is what we project. Now, but if for any reason prepayment speed becomes faster than 160, say 250, we are going to get back our cash flows in 6.4 years. If it moves as fast as 600 PSA, we're going to get back our cash flows in just 3.2 years. Now, the other way around, if our prepayment experience slows down to say 125, or even the benchmark, the PSA benchmark, 100 PSA, well, it will take us as long as 11.2 years as against 8.6 years. So you see the role prepayment plays in a mortgage pass-through. It distorts the cash flow. Now, some investors don't want to see this prepayment. They want to be able to manage it, to the barest minimum. Okay, now in discussing prepayment, there are two forms of prepayment risk. One is what we call contraction risk. The other is what we call extension risk. Contraction risk is the risk that the cash flows on a mortgage pass-through will accelerate because of a fall in interest rates in the economy. Now, naturally, when mortgage rates fall, borrowers tend to refinance because it's not cheaper to borrow. So they tend to just refinance their mortgages, their obligations. They go just take another loan at a cheaper rate and pay down the previous loan. Now, when that happens, remember we are talking about a mortgage pass-through. Cash flow received from the pool of loans are transferred or transmitted to the mortgage pass-through investors. Now, but this happens at a very unfortunate time when rates are going down. When this happens, cash flows are moved automatically to the mortgage pass-through. Now, the mortgage pass-through are dumped with cash at an unfavorable time, meaning they need to reinvest these cash flows at a lower rate. We call that a reinvestment risk. So that is one of the effect of a contraction risk. Now, the second one is if for any reason the mortgage pass-through is callable. Remember, we mentioned in one of our previous classes, a callable bond is a bond that the issuer can redeem part or all of the bonds before maturity. Now, if this mortgage pass-through, remember, is a bond, if it is callable, what that means that when rates fall, and remember that an issuer will more likely to call a bond when rates fall than when rates are rising, because it becomes now cheaper. Now, if it is a callable bond, now what that happens is that now, because of the fall in rate, ordinarily you should expect a rise in your bond price, some capital gain, but because it is callable, you may not realize as much potential compared to a non-callable bond. So we are saying there's a sort of price compression because of a fall in interest rates and because the bond is also callable. So these are the two effects you suffer from when you invest in a mortgage pass-through and you're exposed to what we call contraction risk. Now, the other risk is extension risk. Is the reverse of contraction risk. Now, if rates are rising in the economy, we projected a 165 PSA. If rates suddenly are rising in the economy, mortgage borrowers will tend to even slow down on their prepayment. Now, we already projected a prepayment of 165 PSA based on the interest rates, forecast of interest rates in the economy. Now, if for any reason now rates are now going up, they will even slow down because they want to enjoy the lower contraction rate as against the prevailing rate in the economy. Now, when that happens, they will even slow down on their prepayment. Sometimes they even stop to even prepay. They just pay the contractual principal repayment and then the interest. Now, when that happens, what is the effect? The effect is that it will take us longer to get back all the cash flow as an investor in a mortgage pass-through. So it leads to what we call extension risk. Now, there are two side effects to an extension risk. The first thing is that generally, when there's an increase in rates in the economy, we know that the first property of a bond, one of the properties of a bond is that increasing rates, there's a fall in bond price. So naturally, you suffer some capital loss from your investment in a mortgage pass-through because there's an increase in rates. Now, secondly, now because there's a slowdown in prepayments, your cash flow is now limited to basically the scheduled principal and then the interest. You don't even get enough projected prepayment. Sometimes you don't even get prepayment. Now, a student asked me this question 2 years ago. It was a brilliant question. He said, but you've been talking about prepayment as a problem. Now, we are not saying it. How come it's a problem? It's a good thing. Now, here, why we say its advantage is because there's a projected prepayment of 165 PSA. Anything slower than that or faster than that becomes a risk. So in this case, you are saying, when you don't even see that projected prepayment, you are now limited to only the scheduled principal and interest. Now, it's a risk. So that is the second side effect of an extension risk. Now, if you look at our schedule here, now, this side will suffer from contraction risk. This way will suffer from extension risk. Okay, now these are the two impacts. These are the impacts on our investment when we invest in a mortgage pass-through. Let's take an example from the curriculum to wrap up this class. Now I have this example 7, a mortgage pass-through security. The first question says, a non-conforming mortgage, A, cannot be used as collateral in a mortgage-backed security, does not satisfy the underwriting standard for inclusion as collateral for an agency residential mortgage-backed security, does not give the lender a claim against the borrower for the shortfall between the amount of the outstanding mortgage balance and the proceeds from the sale of the property in the event that the borrower defaults on the mortgage. Now, C is a non-recourse loan. Now, the answer here is B. We said a conforming loan is a loan that forms the pool from which an agency-backed security is issued. But a non-conforming mortgages, those mortgages that cannot pass through the stringent requirements, from which an agency-backed security is issued. And B correctly describe a non-conforming mortgage. It does not satisfy the underwriting standard. We mentioned for underwriting standard as regards the maximum loan amount, to talk about if insurance is required, loan to value ratio. We mentioned those factors earlier on. Then the second question says the monthly cash flows of a mortgage pass-through security most likely A, are constant, change when interest rates decline, C, are equal to the cash flows of the underlying pool of mortgage. Now, C is wrong because you know that the 5.5% pass-through rate was lower than the 6% mortgage rate. Now, they are not constant. Cash flows, they change based on the prepayment speed. So the answer is B, they change when interest rates decline. Money will accelerate. Number 3, a prepayment rate of 80 PSA means that investors can expect 80% of the par value of the mortgage pass-through security to be prepaid prior to the security's maturity. Is that correct? 80% of the borrowers whose mortgages are included in the collateral backing the mortgage pass-through security to prepay their mortgages. The prepayment rate of the mortgages included in the collateral backing the mortgage pass-through security to be 80% of the monthly prepayment rate forecasted by the PSA model. The answer is C. Now, when we talk about, we said PSA is the Public Securities Association benchmark, used in forecasting prepayment. 100 PSA is the standard benchmark. Anything below that, what we're saying is that if you have an 80 PSA, we are saying the speed of the prepayment expected on the pool of mortgages will be below the standard rate of 100%. If it is more than 100%, it's going to be faster. Question 4. All else equal, when interest rates decline, what do you think will happen without looking at the options? Now, we said when interest rates decline, this will make mortgage borrowers to accelerate on their prepayments. When that happens, you're going to have a contraction risk, meaning the average life of the mortgage pass-through will be shortened. Now, let's look at the options. Investors in mortgage pass-through securities face extension risk? No. The weighted average maturity of a mortgage pass-through security lengthens? No. The decrease in the price of a mortgage pass-through security is greater than the decrease in the price of an otherwise identical bond with no prepayment option. Now, I have an issue with this for some time now. This is the correct option, but this is not properly framed. It should be the increase in the price of a mortgage pass-through security is smaller than the increase in the price of an otherwise identical bond with no prepayment option, and is clearly explained in the answer here. Okay, now this brings us to the end of this class. It's getting quite interesting now, but you notice here there's an issue here. The issue is prepayment. Every investor in a mortgage pass-through is exposed to what? Prepayment risk. A pension fund may be concerned about prepayment risk, contraction risk, or extension risk, because it wants to match its liability with the asset liability management. So a pension fund may not want to experience contraction risk or extension risk, or you may want to maybe expose to only extension and not contraction risk. Now, in the next class, we're going to see how we can structure mortgage-backed security to handle either contraction risk or extension risk, or even handle both of them. Thanks for watching.